Welcome to the daily update, where I'll go over the action in the market for Wednesday, April 24th, and then we'll see how things look for Thursday, April 25th. Had pretty much an unchanged day. It was mixed across the different indexes. The S&P was up just barely, but it goes in the books as a positive day. We are seeing some improvements with our technical picture here, but at the same time, we're still negative for right now. We still have a lot to overcome to turn back more positive. One thing that is interesting is the parabolic SAR chart has now turned back to positive. We see a dot underneath. On the negative side, Meta or Facebook came out with their earnings and they've not been well received. And we have the futures down at the time I record this over 0.6%. So we could look at a gap lower in Thursday's session if that continues. We still have many hours before the market will open. But this will really tell. Is the market going to buy on weakness if we do see a gap lower open? Is that going to get rectified before the open even happens and we end up changing what now looks to be a lower open? Or if we see some strength, are we going to see some selling into that strength? We did not trigger a ZWAG NYSE breadth thrust yet. We're still in that window, that 10-day period of time when it could be triggered, but it has not triggered as of yet. So let's go back and talk about what happened, and then I'll go through the charts. Right at the open, we did have a gap higher open, and prices hit resistance at R1 at 5,088. That ended up setting the high for the day. Then we fell down to the unchanged level and went below that. Support failed at the daily pivot at 5,058. As the day went on, we broke through that daily pivot. We never made it down to S1, but we did find support at 50-50, and that's been kind of a significant support level. Anywhere from 50 to 55 down to 50-50, the market's really been doing a tug of war. There's a gap in the chart previously that's marking this level that right now anyway, the market's using as support. But then we were able to rebound back above the daily pivot and the unchanged level, and then we fell back down to the daily pivot again, so it was a pretty choppy day. And then prices did close slightly positive, so we were able to get back above barely the unchanged level. We were up 0.02% on above average volume. This is one of the days we didn't see a lot of movement from close on a closing basis. We saw a lot of choppiness intraday as the bulls and bears try to battle it out with each other. So we did see a pickup in volume. We're still negative in the short and intermediate term. We're positive in the long term. In Thursday's session, we're going to get one of the inflation reports. There's a component in the GDP, the advanced GDP, that talks about inflation. And so the market will react to that. And then in Friday's session, we're going to get the core PCE. That's another major inflation report that will be coming out. And that's dealing with inflation and then interest rates. We also want to keep an eye on the different geopolitical things going on around the world, specifically in the Middle East. Some comments that we can make. Meta is down about 10%. I saw another report saying it was down 15%. So it's chopping all over the place. They didn't have positive guidance. At least the market didn't see it that way. And so they're getting hammered. They reported after the close on Wednesday, and they're down in the overnight session. That's right now anyway, really taking Asia down. We'll have to see how Europe opens up and if it reacts to that as well. The parabolic SAR has turned positive. So that's switching our intermediate term look more to the positive side right now. Oil ended up declining down to $82.81 a barrel. I may drop that off of this now that things seem a little bit calmer in the Middle East. On a short-term basis, we still have our slope oscillator. Our oscillators, whether they're short, intermediate, or longer term, they're showing some improvement, but they're not really crossing over positive yet. So the momentum is still negative. Intermediate term, these are also momentum-based indicators. The TTM squeeze, the ease of movement, the bullish percent index for the NASDAQ 100, and the Chaikin money flow. Long term, we're still extreme positive on a trending basis when we look at our 150 and 200 period moving averages. And we're still wondering if this week is going to change this scenario. The idea that the Fed is likely done raising rates, that's in question now. if we see really strong economic reports. And they thought they were going to be cutting rates in 2024. That's also in doubt right now. The dollar was up and interest rates were also higher. This pressured stocks. We climbed back up to 4.65% with the 10-year yield, where we had been at 4.6%. We're still inverted with our yield curves. We did tick up just a notch as far as sentiment is concerned. We're still negative, but we had been at 40. We closed at 41. Our trend is still negative. The red line is still on top. The ADX is still above its moving average, even though it's rolling over. If we really switch over to positive, we would probably see that cross below the moving average, which would suggest a weakening trend. And then if we see the green line go back above the red line, that would turn things more positive. But for right now, it is looking a little better, but it's still negative. And we're above 20, so that suggests we're in a trending environment. Our bias is positive. Yeah, it was barely. I'm really kind of going off Tuesday's session, and I'm keeping our momentum at mixed for right now. We still had a real negative period that we don't know if we're coming out of yet or not. Economic reports. We did get the weekly MBA mortgage applications index. This week it was down 2.7%. Last week it was up 3.3%. Durable goods. This came in a lot stronger than expected, which is showing economic growth here. It came in at 2.6%. They expected it to be up 1.8%. Last time it was up 0.7%. When you take out transportation, it was actually weaker than expected. It came in up 0.2%. They expected it to be up 0.3%. Last time it was up 0.1%. Here are some charts. These are the mortgage applications showing how it did drop off in the latest reading here. And that might have to do with rising interest rates. Then we look at durable goods on a year-over-year basis, where it's actually still coming down for the most part. Even though we had a strong report, when we measure this year over year, it is declining. And then non-defense, when you take out aircraft, year over year, came down a little bit, but it's still just slightly above zero. Here's a month-over-month basis. Where a few months back, we were quite negative. We showed some improvement than last month. And then in this report, we did see a bit more of an improvement. Then I have a number of charts to go through here. This is the NFIB Small Business Confidence Index, and this is not necessarily positive right now. When we drop below this red line, that's typically when we see signs of a recession, and this continues to fall, and we're getting a low reading at 88.5. We had that report come out recently, and we look at a 24-period moving average, which is also continuing to decline. So small business operators and owners, they're not really confident about what's going on right now. Then we look at the S&P and the stocks above their 10-day moving averages. Now, what I go through in my videos is I look at 20, 50, and 200. I brought this up because it's a shorter term moving average based on 10 periods. And this is also showing some improvement, which is confirming what we're seeing in our other studies. And we have the truck tonnage index, where we have been coming down with the S&P. That's the purple line. We're declining just a little bit here with the truck sales that are happening right now. And this tends to go up when we're in a stronger economy. We've been pretty much going sideways now for the last 4 years or so. And we're looking at some earnings per share estimates. We're now coming in to the dark blue areas. These are estimates, what they think is going to happen, the consensus, that we're going to be up 3% for the first quarter. And those are the earnings that we're getting right now. Then they do project things looking a little more rosy going out. And they're also looking okay going out into for the full year of 2024 and then into 2025. And equity positioning across all sectors. You can pause this if you want to look at this. But most people are getting out of utilities, and most have been getting into the mega cap growth and tech sector, which is not necessarily a surprise. We're seeing positioning really starting to weaken in some of these other areas. And this is just interesting. We're seeing the flows into cryptocurrencies. It's not really picking up. We're not seeing that whole craze thing that was happening a few years back, where apparently it looks like a lot of the weaker hands were washed out, the folks that were trying to use it as a cash machine and getting all their friends involved. And those folks pretty much got wiped out, because now they'd be doing okay if they just held on to it, but a lot of them decided to sell. but we had been seeing a real inflow into cryptocurrencies. Now we're seeing that really dropping off as it's been under pressure lately. And some of this could be the new ETFs that are now available, where a lot of institutions suddenly find themselves having to buy into these funds as well. Some Twitter charts. Lance Roberts, he comes from Real Investment Advice, and he does a video every day. It's about an hour long. It's like a TV show kind of a thing. And sometimes I watch him, sometimes I don't. They also have a newsletter that's freely available if you go to realinvestmentadvice.com. He posts on Twitter from time to time. And what we're showing here are the earnings and gross buybacks. Okay, so we have earnings which are in blue, which are coming down just a little bit, but forecasted to go up. And then the buybacks, which are in green, and this tends to be more positive for stocks. And then his tweet says this year buybacks are expected to reach a record 1.1 excuse me, a record 1.15 trillion according to Goldman Sachs. That's up 16% from 2023. Remember that buybacks don't care about your market views. And that's true. They're going in and they're just buying. They're doing things because it's like, okay, we're just going to go in and buy our stock. No matter what we do as far as a technical analysis viewpoint, and a lot of this stuff gets reported late. So for us to try to front run these kinds of things is really difficult to do. Buybacks have begun to pick up, but have plenty of room to catch up to earnings, which is the most important driver. So that they're trying to do things to make their earnings look better by going in and buying their stock. So I would take this chart more as positive, but it's nothing that we can really follow on a day in and day out, excuse me, on a day in and day out basis. Then he also had another post. Speaking of buybacks, we're almost through the blackout period, which will bring a primary buyer of equities back into the market. That's what companies do. Right now, 97% of S&P 500 corporates, they're in their blackout period where they can't go in and buy or sell their own stock a period before their earnings come out and then a little bit of time after their earnings are then released. Once this gets out of the way, then that will allow these buybacks to continue. And this may be some of the lower than average volume that we've been seeing and some of the pullback that we've been seeing, as this could be one of the causes of that actually happening. There's other causes too. We were really overextended. The basic scenario is shifting to be more defensive now. So this is just one area. He also had another one, the year-to-date repurchase authorizations, where it's up, but it's not up as strong as it was in 2023. Then looking at retail investors, and I found this kind of interesting. That's us. Those are people that work through a brokerage. We don't have a seat on an exchange. We don't work for one of the big banking companies or anything like that. These are folks that just come in and buy and sell stocks. And it's really dropping off as retail investors are doing less purchasing now. And then this is also renewed interest in bank rate issues. This is what we've been trying to keep an eye on here. We had almost a year ago now, the banks out on the West Coast, the Silicon Valley Bank that really ran into some problems. And then a few months ago, we had the New York Community Bank, and we're just waiting to see, is more ready to drop? Well, this could feed into that, causing more pressure on these smaller banks. Because it says U.S. banks finished the year with almost $400 billion of unrealized losses on held to maturity assets. The assumption is this would not be a problem because they thought the Fed was going to come in and cut rates. See, they're showing a lot of losses over here that they haven't realized yet, but it's on their books. Now that the Fed may not come in and cut rates, that could cause these to actually turn into losses, which could feed over into more of a banking situation. It says, but what if it doesn't happen? And that's where we're at right now, trying to figure that out as far as our interest rate scenario. Keeping an eye on all of this, we should be bottoming and starting to come up, which we may have started a few days early, according to this cycle right here. Then our intraday chart, getting into our charts to do some analysis here. We gapped higher and we got up to R1 and that set the high for the day. We just didn't have the strength to be able to get any higher than that. We came down below the unchanged level. We did set some initial support at the daily pivot, tried to bounce up, but then fell down below it. This is when we came down to that 50-50 level. It's kind of interesting, 50-50, win, lose. And we were able to bounce up off of that, get above the daily pivot, the unchanged level, and tried to make a bit of a comeback here, but it didn't really help. Then we went back down to the daily pivot, and then going into the close, we were able to get back above the unchanged level and then pretty much go sideways into the close. Here's our intraday chart. You're going to notice over here on this side, this is after Facebook, Meta reported their results. We just saw a real decline in the S&P futures. The NASDAQ 100 futures are likely very weak as well. We'll have to see how that plays out in Thursday's session. We're still looking a little more negative here with the red line above the blue line. That means that value is still outperforming growth. And one thought that occurred to me, just something to keep in mind. When we look at the seasonal charts, after we get done with April, we tend to see some weak seasonality. Now, it doesn't mean it's going to play out that way, but historically, that is what has happened, where the month of April, it doesn't really see any real sharp, the month of May doesn't see any real sharp declines, but it doesn't see real advances either. And do you think possibly the smart money is positioning for that ahead of time? And then once we get into the end of May, June is when we start to see more positive seasonality, and then that could switch back over. I haven't read this anywhere. Nobody posted it on. It's just a thought that I had as I've been looking through the charts. Take that for what it's worth. Looking at our growth to value ratio for the S&P, it was up, but then spent the rest of the day coming back. But overall, over the last couple of days, we have been seeing some improvement here with the growth to value ratio. End of day, we were up with growth where we were down with value. We were up, but up less with the mid caps, and up, but up less with the small caps. And for those of you that are new, this middle area, these are the corresponding ETFs. Like this would be SPY. This is MDY. This would be either IWM. I really don't use the SML anymore because that's been changed around lately. So looking at small cap growth to value, it did tick down. We're still dealing with this 200-day moving average with the ratio. Also, a little bit of a tick down, not really showing any improvement with mid cap growth to value, and not really showing an improvement here with S&P growth to value. But we're still bouncing up off this 250-day moving average. Now, it'd be nice if we could get further back up into the rainbow. Not sure if that's going to happen on Thursday or if it's even going to happen at all. But if this could really start to bounce back up, that would be better for growth, which is more the buy low and sell high instead of value, which tends to be more defensive. Saw a little bit of a tick up with discretionary versus staples. We bounced up off of the moving average here, but not really seeing any improvement. Large cap growth is still above its 100-day moving average. It was actually down a little bit on Wednesday, but we are trying to bounce up here. We'll have to see how that plays out on Thursday. The Wilshire was unchanged on the day, but showing a little bit of improvement overall. Here's our trend. We're rolling over, but we're not below the moving average yet with the ADX. The red line is on top, but it is declining. If this crosses below, that would be a weakening trend. And if the green line can come back and cross above the red line, that would turn it over to positive. But for right now, we still default to negative. And we're seeing that as well. We're not quite below the moving average. The red line is coming down with our short-term ADX chart. And we picked up a little bit here with volume, one of the few days that we've seen above average in a while. Sentiment, this has still not been updated yet. We're still showing that the Ulcer Index is giving us kind of high readings as the market has become more fearful. We ticked up just a little bit with the VIX on the line chart as well as the bar chart, and we're above the moving averages here. So we're still at more of an elevated fear level or volatility level from where we had been before. Where the VIX of the VIX, it's ticking up, but it's underneath the moving average, and we're still below the moving average with the bar chart. So this is just showing a slight increase in volatility, but we're starting to turn negative now with the momentum of the VIX. The MACD is rolling over, and we've actually seen a cross below the moving average. We're continuing to go up with the one-day equity put call ratio, maybe some hedging going on there ahead of some earnings reports. But we're continuing to decline with our 5 period. So that when it's going down, that tends to be positive. When we're going down, that's positive for the market. Dropping off here with the volatility risk premium. We were more at the higher end of this band after yesterday's session. Well, after today, we're coming down a little bit further. We did tick up a little bit with this fear gauge, and we ticked down a little bit with this other fear gauge. So we're getting some kind of mixed signals right now. And we might be going back to the point where our risk on, risk off chart isn't really helping us. We dropped down out of this range that we've been in for 2024, but not really seeing much of a change. But it did tick up just a little bit, showing that the risk on is improving slightly. Advanced decline line, we're still looking pretty good here. Based on price and volume, we continue to go up, and we're still looking good here. We're seeing more new highs than we are new lows, and we're starting to turn back up with our 5-period as well as our 10-period moving average study here. We're still above zero with the advanced decline ratio, so that's part of the hope that we've been latching onto that so far is holding up. Accumulation distribution is still negative, rolling over a little bit, but could be showing some signs of improvement. And the chicken money flow, still negative, but starting to come back up. This is also showing some signs of improvement, but hasn't turned positive yet. The chicken oscillator, still negative, but showing an improving reading there. And then our cumulative NYSE advanced decline line ticked down just a little bit, both with the cumulative reading and the NYSE the regular advanced decline line. But we're still ticked down just a little bit here with our other NYSE advanced decline line. And we're still looking okay with the cumulative advanced decline line based on price, or excuse me, the common stock based on price and volume. I have a bar here that you can't see that prevents me from seeing the upper end of this chart. And we're still positive here when we take the NYSE new highs minus the new lows. Now, we could drop back down below zero, but for right now, we're still above zero. We're still looking okay when we look at the cumulative advanced decline line for the S&P based on price and volume. And we're seeing it kind of shoot up a little bit more based on volume. That could be positive. We came down just a little bit with common stock with the advanced decline line studies, a little bit above the moving average with the S&P, the mid caps, and we actually turned down with the small caps. So here, and you might hear a cat in the background. He's just saying hello to everybody. We do have some overhead resistance if we get to the point where the market starts to go up. We also have the 50-day moving average above current prices. Down below, we were above average with volume. Looking at our 20-period double and triple exponential moving average study, we didn't close there, but we came a little bit above both of these lines, but we ended up closing back down in between the two lines with the 20-period. We're still looking okay here with the 20-period, 50-period, and 200-period moving average studies, showing a little bit of an improvement, but still negative with the force index. We're no longer extreme in the short-term stochastics or intermediate-term stochastics. We're turning up, but still extreme negative in the long short-term stochastics. And we're below the midpoint, but we're in the -1 standard deviations channel. So we're not necessarily extreme, but we're not positive yet either. We need to get above the midpoint and then see the midpoint turn back up. Intermediate term, we're turning up, but still negative with the balance of power. We're still looking at a little lighter shade of purple here with the go, no-go system. So that's still negative with a slight positive slant. We're bouncing up from the lowest low value, but we're still below the midpoint on this chart. And we're still seeing the lighter shade of red here with the TTM squeeze. After it came down and hit this black line, it's starting to go back up, but it has not turned positive yet. Here's a longer term look at that same chart to give you a little bit more perspective. Dealing with the 50-period moving averages, we're right at the exponential moving average based on 50 periods. It would be better if we could get above the 50-period simple moving average. We're not there yet. The 100-period moving average, it does look like this was providing support, even though we didn't quite come down to it. We've been able to bounce up off of that. And this coincides with a pivot level that we saw in the mid caps. We're turning up, but still negative with the ease of movement. We're flat with the Erin indicator, but we are negative. And we're above zero and continuing to go up with the S&P McClellan oscillator. So we're turning up based on price. We're looking a little stronger based on volume. And I like to point this out. Sometimes this is positive for us as it gives us a little heads up before we see it actually happening with price. But we need to confirm it with other charts because we've also had some false signals from this as well. We came down, but we're still positive with the NYSE McClellan oscillator. So we're just barely starting to turn up based on price and volume with the summation index for the NYSE. Looking positive here. The Swenlin trading oscillators above zero and advancing based on price and volume. But on a momentum basis, we're still looking negative with the PMO, turning up with price and volume, but still below the moving averages. We're looking positive here with the percent of PMOs that are rising. That's actually positive. We're coming out and no longer extreme negative with the buy signals, and we're just kind of chopping sideways here with the percent of PMOs that are above zero. We continue to be neutral with the Elder's Impulse system for the S&P. Now, this is big. We have a dot underneath. Is it going to last? If we get hit really hard on Thursday because Meta is just going to bleed through the whole market, we could lose this pretty quick. But for right now, based on what this indicator is saying, and I put a lot of importance in this indicator, we have switched back over to positive on the daily chart. Slope oscillator, though, is still extreme negative, trying to turn, but still below its moving average. The MACD trying to turn below zero and still looking more negative. So when we look at the momentum in the short term, that's the slope and TSI. Those are negative, even though they're showing some improvement, trying to turn up a bit with the MACD, PMO, and PPO. So, but they're still negative, and we're still headed down for the most part with the TRIX and KST, which are our long-term stochastics. And we're battling here with the moving averages. Are we going to be able to get above this 50-period exponential moving average? If we do, then we have the 20-period moving averages possibly to contend with. So far, it looks like the 100-period moving averages have been providing support. We actually turned a little bit more positive with the bullish percent index. We saw just enough of an up move after the open to cross us back above 50. So this is actually turning back a little bit positive. We're wondering if it can remain that way. We're also turning up a little bit with the NYSE bullish percent index and above 50. So this is more confirmed positive. We're bouncing up with the NASDAQ 100 bullish percent index, but we're still extreme negative. We're going up, but still negative with the money flow. We're going up, but still negative with the ultimate oscillator. The red line is still on top here with the vortex. And we're still below 50 with the RSI based on 14 and 9 periods. We're still below the moving average with on-balance volume. We're flattening out here, but have been improving with our 20-period moving average study of those stocks inside the S&P. Actually turned down a little bit with those stocks above their 50-period moving average. Still going up with the 100-period moving average and flattening out a bit here with the 200-period moving average. The copy curve trying to turn up, but it's still negative. Also confirming that momentum is negative. We're continuing to go back up here with the Sean trend meter. So that's still showing some improvement. And we're wondering if the bottom of this Ichimoku cloud kind of lined up with the 100-day moving average and the pivot level for the mid caps. So we did see a bit of a convergence there. And for right now, anyway, we've been bouncing up from that. Standard deviation is dropping off, but it's still showing that we were going down pretty far, pretty fast here based on the last 10 periods. We're looking positive with the Heiken Ashi chart with the open candles. We're still negative with the Kigi chart, but we are pointing up. We're negative with the Renko chart, and we're trying to turn back a little more positive with the 3-line break. So getting some mixed signals here. With the long-term chart, we're still below this 5110 to 5111 level. We're about, 40 points away from that if we do try to make a run for it. We're still looking extreme with our 150 and 200 period moving averages. And we're still negative across the board according to the Keller market model with the S&P mid caps, small caps, and NASDAQ 100. We're negative in the intermediate term with the small caps. And we're negative across the board with bonds. We're positive with long-term commodities. We're negative with the short-term stocks. No change here on the decision point scorecard here. Negative in the short term, positive in the intermediate term, mixed in the long term. And we saw lots of blue coming out here. It kind of made an appearance. We did have the materials. It crossed below 50, which that's more middle of a business cycle type of a thing. And so that could actually give the market some support. But then we're seeing staples. It crossed back above 50, and that's more defensive, where Canada had a little bit of trouble. But then all the other things that happened here, where we had the S&P going above 50, that's the chart that I showed you. Discretionary is looking a little bit better, where it's been quite weak lately. Healthcare, that's more defensive. That's seeing a MACD crossover positive. And the tech sector, it dropped below 20 with the bullish percent index. Now it's crossing back above 20. So this could be showing some signs of improvement here. And the Dow's had a bullish MACD crossover. So we are seeing some technical improvement. We just need to see more follow through here, where we're still going up with the equal weight index. That's red compared to the S&P 500 weighted index. We declined just a little bit here as the broad market did a little bit better than the mega caps. And the Dow was down just a little bit, but it's been holding up fairly well. It's still below its 50-day moving average. We continue to be positive with the diamonds when looking at the Elder's Impulse system. We're continuing to go up, but we might be hitting some resistance here with the NASDAQ. And also, and it's hard to see because I have all these things that are on here. We're also possibly hitting a little bit of resistance with the NASDAQ 100, but we did get above this pivot level, which also had been acting as resistance. The Elder's Impulse system for the QQQs still remains neutral, but the momentum is negative for the NASDAQ 100, even though this is trying to turn back up. We're crossing over from the 20 below the 50-period moving average. We're also seeing that in the S&P as well. So that's more negative short to intermediate term, but we have been seeing a bit of an improvement with the NASDAQ 100. Small caps ended up being down, just kind of going back a little deeper into their range that they've been in. We've gone from being positive over to neutral with the Elder's Impulse system for the small caps. We're still above the support level now. When we're above it, it acts as support. When we're below it, it acts as resistance. We turned down a little bit with the RSI and we're below 50. The longer term trend is still positive. The momentum is still negative, but trying to improve. The mid caps, this is that pivot level that I pointed out. This is about the only thing that I could see. Now, it could have been something unrelated to this. These are just the charts that I look at where the mid caps have been one of the stronger indexes. It's come in first place the last couple of weeks on a technical analysis score that I go over in the deep dive video. We still have the 50-period moving average here, but maybe we did get some support from the mid caps. And they still remain positive with the Elder's Impulse system for the mid caps. Apple was up 1.25%, but still below its 50-day moving average and still in a downtrend. Here's Tesla, where it did come out with earnings. It ended up being up over 12%, but we're still in a downtrend and we still have not made it back up to the 50-day moving average. NVIDIA is now dropping a little bit below its moving average here. It was down 3.33%. Microsoft trying to fight to come back to its 50-day moving average, not quite there yet. Meta, which is just going to get hammered now. We would be down in here somewhere. It's down anywhere from 10 to 15% in the overnight session. We were looking better. There might have been a little bit of front running going into the earnings report, but the market is not really enjoying what they saw as far as that is concerned. Amazon, they're going to be reporting too. They're falling just a little bit below their 50-day moving average. Google, haven't shown this chart in a while. It's pretty close to setting another new all-time high and looking a lot more positive after we had come all the way down to its 200-day moving average. We were able to bounce up off of that. The FANG index was up 0.5%, but we closed well off of the highs, but we were up nonetheless, but we're still below the 50-day moving average. Financial sector, virtually unchanged, but down slightly. It's still above its 50-day moving average. And we're keeping an eye on the staples to tech ratio. When this is going down, that means staples are underperforming and that tech is outperforming. That's more growth. When this really starts to go up, that means that staples are outperforming tech. We came up to this moving average and we're coming back down just a little bit, but we just want to keep an eye on this chart. If this continues to go up, that would be part of what we're concerned about with the market turning more defensive. The dollar ended up being up just a little bit. We're not back up into the 106 range, but we're in the high 105s. Oil was up to $82.81 a barrel. Looking internationally, coming down just a little bit with our 10-period correlation and kind of declining overall now with our 50-period correlation. But keep in mind that there's a one-day lag from the international chart, the MSCI World Index, from the S&P 500. We don't get that till the next business day. We were up just a little bit with the total U.S. stock ETF, but we're still below the 50-day moving average. We were up with the 10-year yield. We were down with the 10-year based on price. And then looking at our growth to value ratios, yeah, showing a little bit of an improvement here, but nothing too major with the Qs to S&P, discretionary to S&P, and large cap growth versus large cap value. Large caps, mid caps, and small caps, but they're still below their moving averages, so they're not really showing any strength. We did cross just barely back above 50 with our 10-day average of the S&P 500 highs minus the lows, so that's turning slightly positive. And we're back above zero based on price with our 19-day moving average of the advanced decline ratio. We had already turned positive. We stayed above it based on price, and we're also looking more positive based on volume. And we're still looking a little bit better with our 50-period moving average of the new highs minus the new lows for the S&P. We're coming back up above zero. But we're still below zero when we look at the broad market and take a 5-period moving average of the highs minus the lows. This is really coming down now, and that could put some pressure on the S&P, as the S&P has really been underperforming utilities lately. This is the Staples to S&P 500 ratio, which is really starting to spike up, which could also pressure the S&P unless this ratio starts to come down. We have not seen a new ZWAG NYSE breadth thrust yet. We have to get above this red line from the time that we saw this extreme negative reading until we get an extreme positive reading. We have 10 trading days for that to happen. We still have some time left here, but we have not hit that yet. So what's our outlook for Thursday? Big earnings week right now. Microsoft, Meta, which reported, Tesla, which reported, Google's going to be coming out, and then 40% of the S&P 500 will report this week. And we're still negative in the short term and intermediate term, but are seeing some signs of improvement. We're going to get advanced international trade in goods as well as advanced international services and retail inventories. I won't show charts of these. These don't really tend to have that big of an impact. We're going to get weekly jobless claims and existing claims as well. This is kind of the big one, the first reading for GDP for the first quarter of 2024. And then we want to just be aware of weird things going on in the world that could escalate and impact the market. So on Friday, we're going to get the core PCE. We're also going to get consumer sentiment as well. And here's a block showing GDP and initial jobless claims. They've been coming in at 212,000 like for weeks in a row now. And there's some talk about, is there a little bit of manipulation going on here? I mean, it's not 213, it's not 211, it's coming in at 212. Be interesting to see what Thursday's number is going to be. Seasonally, we're neutral to positive with the Dow, neutral to negative with the S&P. We're flat out negative with the NASDAQ. And then looking at the 19th trading day of the month, where we do see some positive seasonality during an election year. And this is just showing how weakness isn't abnormal, where we really, we showed weakness, but now we're trying to just get back up to the average here if we still see some improvement. This is also below the average of the top first quarter. So maybe we're just coming back up to this average level. Thursday tends to be one of the more positive days of the week. And we're coming into the latter part of April, which tends to be positive. And this is what I was looking at this chart going, okay, maybe the market's getting a little bit more defensive as we close out April, because we tend to see some seasonal weakness throughout the month of May. And then once that's over, they'll jump back over into their growth stocks, because we tend to see real positive upward action going through the summer months. I don't know if that's going to happen. Just something that I observed. Haven't heard anybody else talk about it, but just something to keep in mind. Where the first couple of weeks tend to be negative for the month of May. Tom Bowley has us out of this week time. We should be coming back into a positive period for the month of April to finish out the month. And even though we have a pretty good record, we're up 13 out of 18 times and down 15 out of 18 times. The overall return for the month of May is not all that stellar. So the warning signs, we're still extreme negative with the NASDAQ 100 bullish percent index, but it is bouncing up. The Chaikin money flow is still extreme negative, but bouncing. The Chaikin oscillator is negative, but starting to come back up. The ultimate oscillator is negative, but bouncing. The copper curve just flat out negative. It's a momentum oscillator. The vortex is negative. It had been improving, but now the red line is starting to go back up. Our oscillators are declining. and they are still showing that our momentum is negative. We're still below short-term, intermediate term, and long-term support, and we're still negative with the momentum for the NASDAQ 100. Positive signs. We're positive with the S&P and NYSE McClellan oscillators, and the STO, the Swenlin Trading Oscillator, is positive. The parabolic SAR has now turned back positive. The bullish percent index has crossed above 50. The long-term trend is still positive. The equity put-call ratio is still going down, which is positive. And the financial sector continues to be positive. And we're still waiting to see if we're going to get a new swag NYSE breadth thrust. And I didn't add the Y in here today. So our conclusion, we're negative in the short term and intermediate term, but we are improving. In the short term, we are negative, but showing some signs of improvement, not really seeing anything oversold now as it's been bouncing back up. Intermediate term, we're still below support levels, and we have a little bit longer list of oversold conditions, mainly oscillators, but we have been bouncing where we continue to be positive in the long term. Thank you. I hope you have a really good day, and I will talk to you in the next video.